Okay, good evening again, everyone, and welcome to Aero Services Credit Union, our webinar this evening, our financial webinar. My name is Richard Allan. I am the General Manager at the Credit Union, and I will be facilitating this session this evening. Just a bit about myself. I have been in the financial services sector for well over 20 years, probably going on to or 30 years. I so I have quite extensive amount of experience in personal finance, business finance as well. And I am here to share some of that with you this evening. So this is basically a basic financial seminar in terms of budgeting, uh, ensuring that you have the right mix in your budget, understanding how you should utilize credit to avoid the pitfall in terms of getting in a debt trap, which a lot of persons end up because they have credit available and they utilize it, right? And for all sorts of reasons, which may not be the best reasons. So I'm going to begin, and I have my slide will be up. So just give me 1 second. Okay, so money moves that matter. Aero Services, 75 years strong, honoring the past, embracing our future with a global vision. So this has been our theme for the year, celebrating 75 years as a credit union. So let's move into the topics. Principles of financial success. Money moves that matter. And firstly, plan and budget wisely. Avoid the pitfalls of credit, becoming over-leveraged. Live on less than you earn, and make money work for you. And finally, plan and invest for retirement. So planning and budgeting wisely. When we develop our plan, we start off with a plan for, it could be a long-term, in terms of long-term planning, medium-term planning, and then short-term planning, right? You need to consider all three areas when planning your financial affairs. So for instance, long-term planning would involve planning for retirement. Medium-term planning may be in the nature of purchasing a car or a home, property. And short-term planning would be more immediate in terms of, for instance, motor vehicle insurance coverage that is due every year, right? School supplies for the kids as they go back to school. For the new school year, they have to buy new books, maybe even new uniforms, etc. So the planning must take all three into consideration. And the reason why your long-term planning is crucial is because your short-term financial activities influence what you can do over the medium term and the long term. So for instance, in the diagram here, in the image that we have here, we have immediate expenses such as groceries, entertainment, short term insurance, dental, optical, midterm, marriage, motor vehicle, new business. Then, this is very important. Key is an emergency fund. A lot of persons miss out on this. An emergency fund. And when any unexpected situations arise, they're caught off guard and end up having to borrow to meet that emergency. Now, depending on the nature of the emergency and the amount involved, it may be most persons may have to borrow. But something like, let's say, a broken windshield, which we should have insurance for. That's part of your financial planning. Should have insurance to cover a lot of your incidents such as that, right? House insurance, motor vehicle insurance, cover as much as you can. You may be trying to save a few dollars today, and it costs more in the long run. So we should have an emergency fund put aside for any unexpected situations that come up. And we know that they may be unexpected in the sense that we don't know exactly what's going to happen, but we know that they do happen. And again, long-term retirement, education, mortgage, and the long-term education may be we have a 5-year-old child and we know that we want to send them off to college in Canada or the USA, or even right here in Trinidad, depending on what they would like to study, requires long-term planning, long-term commitment of finances towards that. And of course, retirement is a major, major long-term goal that a lot of persons tend to ignore until it's too late, until they are close to retirement, and then start to put towards savings towards it, right? The earlier we start, the better. Because time is a multiplier. So once we start at an earlier age, at an earlier point in time, the better, the more momentum our savings can pick up in terms of returns, right, over the years, and the effect of what you call compounding interest. So I'll get a little more into that as we move along into the presentation. But our plan, our budget, financial plan should take into account all of these on a monthly basis. Some financial discipline practices. Budget to pay yourself before everyone else. Save at least 10% of your net income. And this is how much at minimum we should be saving on a monthly basis. 10% minimum. Budget to live on less than you earn. Again, a lot of times persons get into credit card debt because we just swipe when we need to buy or when we want to buy something and build up a credit card debt, which is a high interest rate, as much as 24%, right? That's really high. And the thing about it is many times the card limit becomes hardcore, which means that the balance isn't reducing, that we are only paying the minimum amount. Now, the credit card is also a good, I shouldn't say good, but it's a trap that a lot of people fall into because their banker will automatically increase the limit on the credit card. So once you're paying every month regularly on your card, they're going to increase your limit, right? And you may not even realize that you have a higher limit and you're swiping away on this credit card. And I spoke about the rainy day fund before. 4, do not adjust your expenditure to match an increase in income. And this is typical of most persons. As we get a salary increase, we start to spend more. We commit more to spending, more to debt. Ideally, what we should try to do is when we get a salary increase, commit more to saving, commit more to investing. Now, just to speak on the difference of saving and investing, A lot of times, traditionally, persons would put their monies in a bank account to save, as opposed to investing where they can get a good return, a better return. Now, of course, the bank account is safe, much safer, or the credit union account, I'd say now, right, is much safer than an investment. However, we have to take into consideration one main factor here, which is the rate of inflation. If you have funds sitting on a non-interest bearing account, you're losing value on your money. And apart from value, well, if you have that money in a commercial bank, you're losing your money, real money as well. I mean, I'm sure many of us, if you have ever left a couple $100 on a bank account unattended and you went back to check your account balance a couple of weeks or months later, you would realize that you have less money than you had left on the account. And that's because of the fees that are being generated on that little bit of money that is there and eating away that balance. Now, I must say that doesn't happen at the credit union. Now, you need to invest where you can get some sort of return over time that counteracts the impact of inflation, right? Which is the rate at which the cost of goods and services rise in the economy. So if you leave $1,000 sitting in an account idle, right, and it's not earning anything, it means to say that, as we know, we always say it, what I could have got with $1,000 in a grocery 3 years ago, I can't get it now, or maybe even a year ago. I can't get those same goods with that same $1,000, and that is the impact of inflation. So it means that the $1,000 sitting in on a non-interest earning account is losing value. So your $1,000 is less than it was valued when you first placed that money in that account. And that's why investment is important, because it gives you an opportunity to counteract the impact of inflation on your dollar. Then the other point, last one, avoid impulse purchases. Avoid enticing new offers from merchants and finance companies. Now, they are very creative and they find all sorts of ways to get your money. So I worked with a retail firm for a few years, and I, being part of the management there, I know the strategies that are employed to get those dollars out of your pockets, right? All sorts of sales are called. And a lot of times, the sale is really to get rid of old stock, outdated stock. But some persons, they see 30% off and they rush the offer, right? So we shouldn't fall for these impulse purchases. Plan and budget wisely, continuing. These two pie charts just basically give some information in terms of generally how persons would, without a proper plan, would spend. And on the right side, prudent financial management allocation gives you an idea as to how one should allocate their monies on a monthly basis. So we have generally, without proper planning, persons may spend as much as 70% of their income on immediate expenses. With proper, prudent financial planning, we shouldn't be spending more than 35% on our immediate expenses. We should have 15% going towards our emergency fund, 20% to the long term, 15% for midterm, and another 15% for short term. Now, if we are in a bad financial position, this may be difficult because we may be paying back loans that are significantly above 35%. So it requires a period of adjustment, and it requires a period of moving towards that goal, right? We recently at ASCU, we had a debt consolidation campaign recently, and a lot of persons benefited from it. And it gave one an opportunity to streamline their finances. The challenge with that is many times, and I hope we have a few persons here on this meeting this evening who would have taken that loan. The challenge is many times we, without the discipline, we end right back up into the same situation where we were before. And that happens to a lot of persons. So I would have consolidated all my debts. My debt service ratio may have been 60%, right? And debt service ratio, which is what we use as we have a benchmark of about 45%. We use that as a guide to determine if someone qualifies for a loan. And it's simply all your monthly commitments divided by your income. So you'd hear us speaking in the financial sector a lot about DSR, debt service ratio. And so what happens is your total debt payments may have been as high as 60%. We do the debt consolidation. That is reduced to, let's say, 30, 40%. So now you have some cash, some free cash that you did not have before. That money should be utilized towards investments. And I'll speak a little more about that later on, and not spending. It gives you an opportunity, as our ad had said, reset your finances. It gives you that opportunity to reset your finances. Now, I'll speak to to avoid the pitfall of credit becoming over, and this is by becoming over leveraged. And there's an easy way for persons to fall into a debt trap, which I'll go on to next, right? According to Theodore Munger, debt is a secret foe of thrift, as vice and idleness are its open foes. The debt habit is a twin brother of poverty. The debt habit. And borrowing becomes a habit for some persons. And I know it stems from a lot of times from the commercial banks who would call persons in to take loans for all sorts of reasons, without actually counseling, without actually working with persons to ensure that they are balanced in how they manage their finances. So avoid the pitfall of credit, becoming over leveraged. So it starts, expenses increase or income decreases. Well, in today's climate, it's mainly expenses increase. The household is in need of extra money to cover expenses. So we're moving on now. Household uses credit and borrowing to cover increased expenses. And the worst thing we could do is utilize the high interest charges debt, right? Such as credit cards. And then we have a few loan shark companies out there. I won't call their names, right? But we have a few. We have them in the island of Trinidad and in the island of Tobago, right? The island, right? So we have these loan shark companies that takes advantage of persons. Yes, Rollins, you find that funny, right? But I guess you know who I'm talking about, right? Debt balances grow and repayment amount is higher as interest rates increase. So your debt balance is growing and the repayment amount is higher as the interest rates increase. So then it's a cycle now. So then we come back now to the monthly income stays the same, cost of living increases, and the debt load grows. So what persons tend to do now? They tend to go back and borrow again. And so the debt cycle goes. So it requires discipline, it requires planning, it requires monitoring our monthly expenditure to avoid this. And it requires where we borrow for not, but for provident reasons, basically, right? And not on whims and fancies, which is what tends to happen. So now the person has fallen into the debt trap. So they begin to miss payments. Then we have to send the debt collector to talk to you because, of course, people start to avoid the phone calls. They start to block the phone number of the lender, right? Then it results in collection action. Now, at Aero Services Credit Union, we are very understanding and we're very open to working through person's finances with them. But as I said before, like for instance, that consolidation product, you cannot put yourself back into that position where you're struggling again. You have consolidated all your debts into one payment. It gives you a lot of breathing room, right? But you still have it's still a debt load that you're carrying. So and the thing about it with these loan shark companies, they're so amazing to me, or I don't know if I want to use another word besides amazing, but um we would pay off a loan today. You would pay off your loan today, walk in with the check, pay them off, and they would be calling you back tomorrow to come and take a loan. And they are aware that you brought in a check, so they know that you would have done a debt consolidation. Most likely, the fact that you came in with a check from another financial institution. But that doesn't matter to them. They are calling you tomorrow, not to come and take a loan to pay off, but they're calling you to go right back into the same position where you were before. So we need to be aware of this and avoid it, right? Because as much as we desire to work with our members and help them through any financial difficulties, um, when it comes to, we have to think about the fact that these funds are actually investments that our other members may have made. And when we have members who are neglecting their commitments, then we have to take necessary action. To bear in mind, every time you miss a payment, it affects your credit rating. So, for instance, part of this debt consolidation campaign, we, especially persons who were not members of the credit union before, but generally we had a rule across the board. So, where persons sought to get this loan, because it's very much in most part, most of it is unsecured. We are very cautious. We would like to help persons, but at the same time, we have to protect our members' funds. So where you had persons were 60 days late and more and so on, we had to decline those loans. Now, the thing about it is when you miss one payment, it affects your credit rating. Your rating actually goes down as well as it shows up on your credit report. So as a borrower, you need to ensure that you make your payments every month and on time. So we have the loan sharks there. So I spoke about this before, avoiding the high interest rates, credit cards, etc. This one, avoid extended term mortgages. Now, many times we're seeking a mortgage and we want a dream house and we cannot afford it unless we go 30 years, 25 years, that type of thing, right? We shouldn't look to go more than 25 years on a mortgage. The interest that you pay over that extra period is significantly more, right, than shorter periods. And I see now we have mortgages going up to 35 years. When when you get in your information on qualifying for loans and so on, you need to always ask how much the interest will be. And as a matter of fact, you can work it out yourself. It would simply be the installment multiplied by um, the term, how many in months, and minus the principal from that. And that tells you how much the interest is going to be. So this is important. So you may not be able to afford the dream house if you go 20 years on your mortgage, but you can still afford a decent home. Also, the same applies to car loans. Every few years, the term on car loans increases because it's such a competitive area that car loans, when I first started banking, were a maximum of 5 years on a brand new car. We have now reached 10 years. And the way the competition is going, it may even go further. As a matter of fact, I think right now some financial institutions probably are going above 10 years. Now, what I would suggest to persons is listen, try and find a car which you could pay comfortably over 7 years. Now, I know cars are expensive as well, but everybody wants to buy the SUV, and we're not thinking about the maintenance. There's a lot of maintenance that goes into it. We have to pay insurance every year. Tires are expensive, right? $1,100 for one, for sorry, not for one, but for a pair of tires. So it's the maintenance, and people don't think about these things. So all of this you have to take into consideration, which is why let's try and avoid paying additional interest on these loans by taking them for longer periods, right? A car loan, take something that costs a little less that you can pay off within 7 years. Avoid consolidation upon consolidation. Now, this is another one where you would can end up paying a whole ton in interest. So, for instance, persons would have come and taken a debt consolidation here, and a few months down the road, they see another credit union offering a debt consolidation promotion, and they decide, okay, I'm gonna go there, I'm gonna take their debt consolidation, and because why? You can do the debt consolidation and get extra money in your hand. That is the worst thing you could do, right? Because there's maybe fees involved, the interest charges again. I mean, if you didn't want that consolidation, let's try and keep it that way. That's the last that consolidation that you're going to do, right? Going forward, you're going to manage your finances properly. If you do have certain needs that come up, like back to school supplies and these sort of things that you weren't able to plan for, you weren't able to save for, then take a short-term loan to handle that, right? Let your borrowing going forward be short-term, 6 months, 1 year for the most. Things that you should cater for within a year, then you don't take the loan for more than a year. Car insurance, right? Because what happens now, getting back into the debt trap, if you take a loan to pay your car insurance for 2 years, what happens? By the time your car insurance comes up for the next year, you're still paying back on the first loan. And that's the cycle as it goes. So it just keeps on increasing. So let's, short-term needs, short-term loans, right? So if you know this is something that's recurring annually, then you don't borrow for more than a year, which is usually how we counsel our members. And once we are aware of the purpose the loan is being taken, right? Now, a practice that a lot of persons do is they take it for, if I take the car loan insurance for 2 years, I'm going to come back next year and I'm going to refinance that loan and add the second year insurance to that now. And again, that's falling into that trap. Take it for 1 year, ban your belly, where you have to cut down your expenditure, and pay it off within a year. And again, refinancing is similar because again, interest charges, interest on interest, it's just a lot of interest that builds up, not in your favor, right? So avoid refinancing unless absolutely necessary. Avoid enticing. Well, I spoke about the new credit officers that offers that some of these financial institutions come out with. Avoid the pitfall of credit becoming over leveraged again. Borrow within your means. Use no more than 70% of your available credit, unless for provident reasons, investment, education, business. Be extremely cautious here. And why I say be extremely cautious here is with my experience in the financial services sector, I've seen a lot of persons borrow to start a business and they failed and they lost property, they lost their parents' property. I mean, I'm sure a lot of us know of people who would have done that. They put up their property for a child or another relative, and the bank sold it to cover the debt. Um, so in business, the best way to develop business is to go steady, right? I mean, there may be certain situations where you may need to go large, but you need to scale, right? But it all depends on the nature of it. But what I'm saying is, in terms of financing, where finance is readily available, like for instance, a mortgage property, persons tend to spend that money badly, and they tend to make unwise decisions. So you always have to be careful, right? And parents, your kids may have the best idea in the world, and they come and they want to telling you they want you to mortgage your property and give them $250,000 to start a business. If you look at um the name of the show, um slips my mind right now, but where they provide financing for persons with ideas, entrepreneurs, they always ask how long they have been in the business, right? So just think about that and be cautious in terms of financing for business. Avoid using credit for wants over needs. I think I spoke about that already. Understand the terms and conditions. Always read the fine print. For example, is the interest rate fixed? Is it variable? Pay on time every time protects your credit score. Automate payments wherever possible. We have a number of payment options. You can set up a standing order. We also now have debit card payments on our website. Well, not our website exactly, on our online banking. So once you register for online banking service, you can log in there and make your payment with your debit card. Utilize waivers for exceptional circumstances. So we know at ASCU Credit Union, we allow persons to, you can request a waiver from the credit union on your payment, but it must be some sort of extenuating circumstance, like persons who would have lost their jobs, we accommodate them there. Persons who may have had health issues and they're unable to work for a while, we make accommodation for those situations, right? So if you're going through anything like that, any of those extenuating circumstances, contact us and let us see what we can arrange for you. So again, we still avoid the pitfall of becoming over leverage. Borrow with a repayment management plan in mind. Pay more than the minimum where possible, right? And this works mainly on amortized loans. Making extra payments via lump sum, which usually requires contractual agreement up front. Budgeting for repayment shows discipline and helps manage your cash flow. Budgeting helps reduce monthly distress from either having to find loan installment money or funds for living expenses. So in terms of budgeting, make sure we have the money for the loan payment. Pay it as soon as you get your salary. Make your loan payment. Put aside your savings, right? Because the longer you hold on to it and you start to spend money, the more difficult it gets to keep in those commitments, especially when it comes to the savings and investment. I will just touch on one topic here. Sometimes persons don't like to borrow, they say they're going to use cash instead. Now, I know I spoke at length about avoiding the pitfalls of credit becoming over leveraged. Now, on the other side of that story is it's always good to have cash. So, therefore, a good practice would be, and this is where the credit unions come in, compared to the commercial banks or other finance companies, we encourage thrift. So you can place your funds with the credit union on a share account, on your share account, or on your fixed deposit account and borrow against it. The rate of interest is extremely low. And you have the benefit of still building up your savings or your investments while you meet your need. And that's different from an unsecured loan because at the end of the day, your loan is backed by cash. So therefore, if you run into a difficult situation, you can now utilize your cash to pay off that loan, right? Now, usually in times of economic difficulty, cash is king, right? So it's always good to have cash. You may have it in your shares account or your fixed deposit account, as I said, but it's still your cash is still there. You would not have spent it and have no cash in hand. So, for instance, if you have to buy furniture and appliances and you purchase it with cash, you would have already acquired assets that are deteriorating, right? Um, that I would say, or that are declining in value, basically. Um, and you may not get back those funds if you were to sell those items, right? But guess what? You still have your cash available. So it's always good to put the cash down on on an investment with us and borrow against it. I will always encourage persons to do that. Invest in property and build equity. You can't go wrong buying land. Land does not depreciate in value. Now, a building does depreciate in value. A building requires maintenance. Land doesn't. Invest in yourself, your children, education. Use lending for that purpose. We provide loans for education. Um, we provide loans for purchasing property as well, and purchasing land, purchasing house and land. Utilize the equity in your property. When you purchase property, there's available to you the equity in that property, which basically is the value of the property minus whatever you own it is your equity in that property. That equity can be used as security for a loan. A lot of persons are not aware of that. And it can be utilized for almost any reason that is legal, right? So you bear that in mind. So therefore, investing in property is, you can't go wrong by investing in property. It is one of the major or, well, most, um, yeah, the most major investment that persons would make in their life, purchasing a property. And as I said, you build up equity in that property over time as your mortgage balance reduces, as property values appreciate. You tend to have equity in that property over time. So, and it's not that property is available to you not only by selling the property, if that's an option, but without having to dispose of the property, you can benefit from that equity through equity financing. So I'm moving on to live on less than you earn. So I have a bit of a story here. This is of multinational, a VP of a multinational corporation, age 61, lost everything after being made redundant. Now, this guy, he graduated from Harvard School. He became a general manager. He moved up the ranks. He spent decades working for oil giant when he was forced to leave. And it said the father of two became depressed and worried about finances, his wife said, right? Now, just to go into it in more detail, The salary of a VP at an oil giant corporation, according to online sources, is around the equivalent of $229,000 a month, TT dollars a month, $229,000 a month. Yet, this VP experienced financial distress upon losing his job. He had sought to refinance the mortgage on his £2 million or 18 million TT dollar home. Right? So he had an $18 million home, but because he lost his job, he was going through financial distress and he had to seek to refinance his mortgage. And I'm using this example to show that it's not how much one earns that determines their financial strength, but it is about how one spends and how one utilizes their income. Now, many of us would say, hey, if I could get 100,000 TT dollars a month, I would be in such a good position financially, such a good financial standard, probably have no loans, right? That's what we would think. However, he was making 229,000 a month. And this is generally what happens. As income increases, lifestyle tends to expand proportionally. So, leading to financial pressure despite higher earnings, increased borrowing to maintain status, higher fixed expenses, mortgage, car loans, because we have to buy a bigger house in a better neighborhood. We have to buy a fancy car, right? A regular 250,000 car is not good enough. I now have to buy $1 million car. Reduce savings and emergency buffers because I'm have to keep up with the appearance of being who I am now, increased financial distress and vulnerability. So without prudent budgeting and financial discipline and planning, because if one has a long-term plan and we ensure, sorry, that we plan well for the future, one may avoid going down this road. So the thing is, expenses can rise faster than income, and we see it happening all the time. So, for instance, I know of someone who they were expecting a salary increase from the government, and they were buying a new vehicle, and they are buying this new vehicle based on the new salary that they're expecting to get, right? And I said, but why don't you, one of two things, fix your vehicle or fix your existing vehicle, which you had all these years, but okay, you want to change the vehicle, buy something that costs a little less, right? Do you need to buy the vehicle that you're buying now, right? Um, because you're going to get a salary increase, but you're already planning to put yourself back in the same financial position that you're in now, where you're struggling every month. So, I mean, and this is some of the thought patterns that kind of lead to us making bad financial decisions. ASCU can help you through that consolidation to reduce financial burden, financial education and planning support, competitive loans and savings products, and encouraging sustainable financial growth. Investment portfolio, why invest, right? So I spoke a lot about the investments and being able to counteract inflation, right? So I'm just speaking in general about fixed investment options, fixed deposits offered by financial institutions, including credit unions, low risk but relatively low returns, 1 to 2.5% annually, slightly higher credit unions. So the banks don't pay much on fixed deposits, credit unions do, however. Um, the thing with credit unions is we don't pay credit unions as an organization don't pay the taxes that banks have to pay, corporation tax. So therefore, it means that we're able to leverage on that and utilize it to do things like pay higher returns. Government bonds and treasury bills, these are good for secure investments as well. Credit union shares, generally a safe option dependent on the individual credit union. So that depends on the credit union. As I said, ASCU, we just celebrated 75 years or are currently celebrating 75 years. If you look at our financials, you'll see that the credit union is a strong credit union financially. And so this is a place where you can place your funds and feel comfortable. Our fixed deposits currently are up to 4% return, right? And so we have a very attractive fixed deposit currently. Just to talk on a bit on rates, right? Higher returns, higher risk, right? Now, I explained that before why credit unions are able to offer the higher interest rate because of that corporation tax that the banks have to pay. We don't have to pay that, right? Because of the nature of the credit union business. And I'll get a bit into that as we come to the end of this presentation. Higher returns, higher risk. I want to, just warn persons, be mindful when you see investments offering um, significantly above market returns, right? Clico was one such case, but persons ignored it because, of course, it was Clico, right? And they were given some really marvelous returns, and a lot of persons and organizations lost their money. There was, of course, the bailout that would have helped, but funds were still lost. So be mindful of anything that sounds like a get rich scheme, quick scheme, or sounds too good to be true in terms of the return. It usually is. Know and understand your risk profile. So if you want to invest, you need to understand your risk profile. Are you an aggressive investor, a moderate investor, conservative investor? And I would say it all depends on where you are in terms of your life cycle. Um, Definitely. So let's say the stock market. A lot of persons like to invest in the stock market, which is an excellent area to invest as well. However, the stock market is one that the return is not guaranteed with time, in the sense that at any point in time, you may not um, be able to recover your investment and make um, with a surplus. As a matter of fact, you could recover with a deficit. So the prices vary, and they vary based on the economic situations and what's happening, right? So you may, let's say you're close to retirement. That may not be a good time to decide to pour money into the stock market unless you have already established a retirement fund. But let's say someone is 55 and they don't have an established retirement fund. That should not be, I would not advise that person to start to seek to invest in the stock market at that point in time because you need something stable, right? The stock market is a bit volatile. You need something stable. So something more like mutual funds, credit union shares would be more your pace. Someone who's young, now starting out, and they're now building an investment portfolio, they can invest in the stock market because the stock market, while it may be volatile and it may, at the point in time when you need your funds as someone who's closer to retirement, the price on the stock could be down. Whereas um, over time, stocks generally appreciate in value. So if you're investing for the next 30 years to retirement, that's a good place to put your money. Excuse me, you're definitely going to benefit there. So all these factors have to be taken into consideration. Again, if one has built a good portfolio, investment portfolio already in terms of your emergency fund, your savings and that type of thing, then the stock market is an option. Oh, sorry, excuse me. Now, well, let me move on to this next point here because I know time is running. What is my knowledge of the financial markets? This is another this is another factor. Do you know about financial ratios and analysis and all these things. Do you have expert knowledge? What is my current financial position, as I mentioned before? Now, at ASU, we have fund managers who are experts in the field, and they manage our funds. We also have an investment committee at the credit union that is comprised of well-educated, experienced persons. So your funds at the credit union are well managed. So we can take that headache off of you, and that um that headache off of you, and that stress, that uncertainty. When you invest your shares in the shares of the credit union, you can rest assured that your funds are being well managed. Right? So last year, or I should say for this year we declared a 4.5% dividend payout. So that means a 4.5% return on shares that were held with the credit union last year. In addition to a 10% cashback on loans, on the interest on loans. So you can't go wrong with ASCU Credit Union when it comes to investing your funds and borrowing from the credit union. But ensure that you mix and match your funds. Short-term savings should be matched with, you have your fixed deposits income fund, the ASCU shares again could be used for short-term, medium-term, mutual funds shares again. Basically, you can utilize shares at any point for any type of investment period that you need to invest funds. And the reason being, you can withdraw your shares at any point in time once they are unencumbered, so it's not tied up to any loan. You can withdraw your shares at any point in time. There's no penalty fee for withdrawing your I would say there's no penalty for withdrawing your shares, right? Now starting, first build up secure savings and low risk investments. Special attention when close to retirement, as I said before, inflation consideration reduces the buying power of your money and savings. So you must invest your money if you really want to save it against inflation eating it away. Right? So as I said, investment as opposed to a saving. As I would have spoken about this a lot already. So I'll just go into this. Credit unions versus commercial banks. Credit union is a member-owned organization. They're owned by the members who are also customers, whereas a commercial bank shareholder-owned. Commercial banks are owned by shareholders focused on profit generation. The credit union, the profit is returned to the members. Earnings are often returned through dividends, loan rebates, cashback, and better rates. Profit distributed to shareholders. Profits are primarily paid to shareholders and investors as a bank. Community. Credit unions are community and member focused. Credit unions are usually emphasize personal service and community development. Banks, commercial banks, profit maximization driven. Banks generally focus more heavily on profitability, expansion, and market share. Credit union generally lower loan rates and fees. Banks typically higher fees. So you saw the whole situation a couple of weeks ago with Republic Bank and the fees. Now, this is a bank that declared over $2 billion annual profit, and yet they're seeking to increase fees. As I said before, you leave a few dollars in the bank. When you check your balance going into negative because of fees that came out from your account. You don't have that problem at the credit union. You don't have that problem at ASCU Credit Union. Right? As I said again, profit maximization is the modus operandi of the banks. Their focus is not on the members or the customers, I should say, but on making profits. So just to recap, discipline, planning, budgeting, and monitoring is required in order to manage our finances well. Avoid the debt trap. of becoming over leveraged. Live on less than you earn. Save the rest. Save and invest the rest. Invest in your future through savings. With ASCU, we have the dividends, 4.5%. We have our fixed deposits up to 4%. And we also have two new savings products that will be interest-bearing products that would encourage persons to save. There's one for children, basically, under 18, where persons can save between whatever age that child is until they're 18. No withdrawals are allowed, but you can use the shares to borrow against, right? If it's for educational reasons, for books, uniforms, whatever the purpose might be. Um, then there's one for short-term savings. If you want to save towards buying a home, if you want to save, because even though you take out a mortgage to purchase a home, there are closing costs, there's legal fees, there's stamp duty that has to be paid depending on the value of the home. So therefore, we have provided those two products. They'll be rolled out soon. Um, and their monthly savings commitment, right? So you commit a monthly amount and you receive interest and interest return on the account, right? So those are going to be launched pretty soon. So please look out for them. I mean, I think those are fantastic products that would help encourage you to your young ones to learn the practice of thrift and savings, as well as for adults who, you want to put aside funds and generate um, some sort of return while you're doing so, right? So credit unions such as ASU seek their members' interests. Other financial institutions seek mainly their shareholders' interests and profit maximization. And that is the end of my presentation. So I made it in just under an hour. So I want to thank everyone who joined on the call this evening. Let me see. If you can give me 1 second, don't leave as yet, because I know there'll be certain persons that um, and yes, oh yes, thanks, Mark. That was Shark Tank is the program I was speaking about. Okay, so thanks, folks. As we would have indicated, those persons who would have taken in that consolidation loan, they would be entitled to get a refund from their loan fees towards their shares account. So you can, okay, yes. So the new products, we will be sharing that information via our social media and via email. We'll be promoting it heavily. So don't worry, you won't miss it. You definitely won't miss it when these new products are being launched. Right? So thank you, everyone, and do have a good evening. Thanks for logging in and joining us this evening. Take care.